Good morning, everybody. It is your daily crypto news, and it is Wednesday, April 17th, 2024. My name is Matt. Apple Podcasts, Spotify, hit them 5 stars. Got an email yesterday from a listener, Jason. Jason said, just like you say all the time on the podcast, I'm no expert, but I'm going to lay out my 2 cents. I think that we may have seen the big drop from the halving already. Ooh, this is getting spicy. Maybe it's more of a hope than a thought, because seeing numbers drop that hard sucks. That's how crypto does its thing. Altcoins saw an average of 50% pullbacks, and the big boys like Ethereum and Bitcoin saw pullbacks of around 25%. Could it go down more? Of course. Could it go sideways? Who knows? Could it go up? Maybe. Something tells me that the traders are getting savvy to the whole buy the news, sell the event aspect, which in the past wasn't consistent. However, as of recently, it's been consistent that prices go up a lot of weeks before a big event and fall hard the weeks of. I hope that this is the case because I don't want to see my portfolio go down anymore. My man's getting hurt. Jason, it's gonna be okay, brother. It's gonna be okay. He's feeling some pain. We have to remember that it isn't a loss until you sell. Either you're short term or long term, and I have found that a lot of comfort in to buy, stake, and hodl. So at this time, it's important for me to remember your horizon. You are in it for quick money, or you believe in your innovation. I know where I stand. Buy, stake, hodl. Much love and thanks for the podcast. Keep up the good work. Jason, thank you for your input. Again, who knows? Who really knows? But this is a podcast. You listen to me for entertainment, news, opinion, all kinds of different reasons. I don't know why. Please let me know, Matt at dailycryptonews.net. Why do you listen to this show? I'm actually kind of curious to hear. We have 2 days until the halving. 2 days, 12 hours, 19 minutes until the halving. But again, I'm going to stick with it. I think we're going to drop below 60 after the halving. But you know what, Jason? You really bring up a good point. We've seen this a lot of time. Pump and then sell the news. And then right before the news hits, the price is low. And then people start to see, hey, we're good. Let's buy again. It's quite possible. After the halving, we pump like crazy. I'm going to stick with, we're going to stay down. Let's see what happens. Speaking of staying down, you can't hold BlackRock's iShares Bitcoin Trust down because it's on track to flip the Grayscale Bitcoin Trust before the end of the month. Grayscale is hanging on to a $2.5 billion lead, and analysts think that April 30th is a good over-under date for the flippening. This time last week, the gap was even bigger. There was around $4 billion spread. Now it's down to 2.3, like I just said. Little history on Grayscale Bitcoin Trust. It began trading in around 2013. But it was only available to accredited and institutional investors. The fund saw assets under management surpass $43 billion in November of 2021. In January, the fund had around $28.6 billion. Grayscale has since seen its assets under management sink to around $19.5 billion. Right now, the current spread between Grayscale Bitcoin Trust and BlackRock's ETF is around Grayscale having 312,000 Bitcoin under management and BlackRock 271. And because of Grayscale's outflows, the spread is getting thinner. Grayscale's outflows overpower the other spot Bitcoin ETFs inflows for the 3rd consecutive day. That brings outflows for yesterday at around $58 million. Nearly $80 million left Grayscale. Most other spot Bitcoin ETFs saw inflows. Obviously, BlackRock dominated with around $26 million in inflows. Do you got a grip of Bitcoin? See, the thing about having a grip of Bitcoin or a grip of cash or a grip of anything is that you want to leverage it. Of course, you could sell it into cash and spend it, but then you lose your asset. You lose that stored value, right? And so you're kind of figuring out, like, how do I leverage this? And this is what, wealthy people do with their stocks, or is they leverage their wealth. And so if you have a grip of Bitcoin, how do you do that? That has been the nut that everybody tried to crack for a long time. And that's when products like Celsius and BlockFi came out. Everybody's like, oh, I can earn on my Bitcoin and still hodl it? That's a thing. I want to do that. Well, a Bitcoin-powered Layer 1 blockchain core chain is now letting investors stake their Bitcoin. Core chain now allows BTC hodlers to earn yield by participating in Core chain's consensus mechanism called Satoshi Plus, which combines delegated proof of work and delegated proof of stake. It's its first of its kind non-custodial Bitcoin staking. And if you know me, you know exactly what I'm going to say. What the hell is this and how does it work? I don't trust it. Okay, so this is from their white paper update. They said key innovations and features is from Satoshi Plus Consensus. They say a core chain standout feature is that Satoshi Plus Consensus is integrating delegated proof of work and delegated proof of stake. This unique blend allows core chains to leverage the security and decentralization of Bitcoin's mining ecosystem while enhancing scalability and the efficiency through staking-based voting. It supports Bitcoin miners by offering additional rewards, encouraging participation, and ensuring the longevity of the Bitcoin project. That all says nothing. They also say it wants to be EVM compatible. Again, says nothing, which means that there's got to be some sort of bridge, which means vulnerabilities. It says addressing Bitcoin's limitations, block size, throughput. Look, it seems like this is a bunch of mumbo jumbo here. Here's the thing, is that it doesn't tell you where it's stored, how you control your private keys. So it's non-custodial, they say, but do you actually control the keys? And then even with, Ethereum staking, you're giving up your coins. And so who are you in trust here? Something called core chain? I don't know what core chain is, unless it's Bitcoin Core, which it's not. At least from what I could tell, it doesn't have any relation to Bitcoin Core or Core Devs. And so you're giving these coins, you're giving Bitcoin, which is now priced at around, $64,000. You're giving Bitcoin to some random project to hopefully earn, it doesn't even say how much you're going to earn. So what's it going to be? 4%, 5%, 6%? There is a believable number, but what if they come out with 20%? Not believable. So I call bullshit. Anyway, let me just put this into perspective. For the past 10 years, and now obviously there's different metrics you can use. You can use the crest, the troughs, you can use different, peaks of Bitcoin price, but let's just use this number. For the past 10 years, the compound annual return rate for your Bitcoin is 104.5%. Now we can look up for the past 5 years, which is probably going to be a lot lower. But here's the fact. If you had that kind of return in the stock market, what would you do? If they start paying dividends, you would just scrape off a little off the top. That's plenty of return for you to be happy with taking 8%, 10% out year over year and still have a 90% compound annual growth rate. So why do you need this? This is honestly preying in on people's greed, in my opinion. You don't need to stake Bitcoin if we're growing like we are growing. Now let's just take this other example. Let's just say you bought the all-time high. I mean, you are unlucky and bought the all-time high, and then we just hit another all-time high of 74. So 69,000 about 2.5 years ago, 74,000 about a month ago. That's 7.25% growth. Let's just say you bought a $40,000 Bitcoin. Even earlier this year, it was called January, or you bought it before the 69,000. Let's say about, again, 2.5 years ago. That's 60%. So you're trying to tell me that you would risk your Bitcoin for 5%? 6%, 7%, or some bullshit 20%. Again, these kind of things, it doesn't make sense to me. Why would you do that? It doesn't make sense. And to top it off, people are predicting that Ethereum and Bitcoin ETFs in Hong Kong, if they go live, could fetch around $25 billion. We're talking about $25 extra billion into the market because of their ETFs, which means more money for you, more growth for you. No trading date has been set, however, but they're expecting around April 30th for the trading to begin. Hong Kong gave conditional approval for a number of spot Bitcoin and Ethereum ETFs, and those will be managed by China Asset Management, Harvest Global, and Hashkey. The level of success of this Hong Kong ETF basically heavily depends on China. And are they going to allow people to purchase them? Not only are they going to allow Hong Kong to actually do the thing, which we actually haven't heard directly from the regulators, we've heard from these asset managers, but is China going to allow their people, the Chinese people, not the Hong Kongese, but the Chinese people, to invest in these ETFs? I personally think they will, either directly or by third parties or intermediaries. They'll be able to invest in these ETFs. Now here's the thing, trading and mining is banned in China. That could be just because it's not regulated. And so a regulated product like this could be more favorable to the Chinese government and the Chinese people. Remember, nothing happens in Hong Kong without China's blessing. So if this actually comes to fruition, that means China is very aware of it. Now, does China have hidden plans? Who knows? But if it does launch, it's because China gave the okay. And finally, a trio of leading AI-related crypto tokens are set to merge following a successful community vote. This is going to be the Artificial Superintelligence Alliance and has announced approval of a new ASI token on Tuesday. This new ASI token combines Fetch.ai's FET, SingularityNet's AGIX, and Ocean Protocol's Ocean into one single digital asset. The new ASI token, the Alliance claims, will have an anticipated combined total value of around $7.5 billion once the merger is completed in May. The objective of this project is to make ASI the network of AI true decentralization of technological development and deployment. And I just want to go back to last year when I said AI tokens are going to be part of the bull this year. And a listener wrote in, I hope you're still listening. A listener wrote in and said, "Are you stupid? AI tokens aren't a thing. You're a fraud." And I just want to just laugh at you. I hope you're still listening because I want to give you a big I told you so. And by the way, we have thick skin here. So please write in anytime you want to disagree with me, Matt at dailycryptonews.net. I'll happily read it down here and we'll have a debate on the podcast. Now let's get into those crypto prices.
Here comes the money.
Here we go. Money talk.
And the time is 9:55 a.m. Eastern Standard Time. Fear greed's at 60. We are at the cusp of neutral and greedy. Bitcoin sitting at $62,765, up 0.6% in 24, down 8 and 7. Ethereum is at $3,045, pretty much even from yesterday, down 12% in 7. Tellers number 3, Binance is at 538, up 1%. And Solana's at 133, up 3%, but down 19% in 7. If you guys don't think Solana's going to pump, I can tell you that you have not been paying attention. Solana will pump. When everything else pumps, Solana will pump. Well, when everything pumps, everything will pump. But 133, Rounding off the top 10, we have USDC, XRP, Dogecoin, Toncoin, and Cardano. The total market cap is at 2.28 trillion. A Bitcoin dominance of 54.2 and an ETH dominance of 16.1. And that was not all for today. Here is my good AI buddy, Neil, reading an op-ed that was written by Senator Cynthia Lummis and Senator Kirsten Gillibrand, talking about the solution for stablecoin regulation. And I will not be back after this, so...
Happy hodling, everyone.
Recent advancements in financial innovation have laid bare shortcomings in current U.S. policy regarding stablecoins, which fails to strike the delicate balance of promoting financial innovation without sacrificing consumer protections or necessary regulation. As the global financial leader, the United States finds itself at a crossroads. We can either be the central player in managing a new generation of financial technology, promoting dollar dominance, protecting consumers, and preventing illicit finance, or we can leave it to other countries to provide a framework for use. Leaving it up to other countries would be a grave mistake. The United States must have a seat at the table. While some current proposals in Congress show promise, we have partnered to craft legislation that solves key policy challenges faced by previous proposals. Instead of drafting legislation in a vacuum, the Lummis-Gillibrand Payment Stablecoin Act of 2024 addresses the dual banking system as it exists today. It preserves states' current authority over non-depository trust companies and ensures parity between federal and state bank charters, while acknowledging the Federal Reserve's role as the guardian of monetary policy. The legislation creates a healthy balance of power by ensuring the Federal Reserve and states must act in concert with each other in supervising trust companies under $10 billion. In drafting this legislation, we prioritized allowing innovation to prosper. Under this bill, stablecoins will create the ability to send a payment anywhere in the world instantly, with a lower fee than the current options. Right now, financial transfer technology like wire transfers can take up to 10 days, which is often too long if the money is being sent for an emergency. It will allow innovators to build new programs and apps that give consumers more control and flexibility. The possibilities for using stablecoins are numerous, and we are just starting to see how financial innovation will thrive once stablecoins become a common form of payment. Part of our biggest challenge in crafting stablecoin legislation lies in assuaging public anxiety. Far too many Americans are unfamiliar with stablecoins beyond splashy headlines of scandals. Where some of our colleagues shy away from the issue, we see these events as an opportunity to fortify our system from a repeat failure. Together, we have created robust custody practices for issuers that prevent the commingling of funds. We have also built in a detailed receivership regime under the Federal Deposit Insurance Corporation, FDIC, for all payment stablecoin issuers, to ensure customers have the ability to get their money back quickly should a problem arise, instead of having to go to a bankruptcy court. The U.S. has the opportunity to be a catalyst for positive advancement in this space without limiting financial innovation. Banning stablecoins or taking a back seat to other countries will not discourage the widespread use of stablecoins. It will merely limit our nation's influence over innovation and consumer protection. Together, we are delivering a comprehensive solution to current shortcomings in the stablecoin space, and our bipartisan legislation gives the U.S. the best chance to maintain safety, soundness, and our position as the world leader in financial innovation.
Really quick, how does any AI, mess up the pronunciation of the United States? Thanks for partaking in my experiment. See you guys tomorrow.